listening to Flashpoints on Pacifica Radio. My name is Dennis Bernstein. We continue our weekly segment on community business with Catherine Austin Fitz, and today we focus on Bush's bailout plan. Secretary of the Treasury, Paulson, has been all over the media talking about his new plan to bail out Wall Street and ease the suffering on Main Street. Meanwhile, Fed boss Ben Bernanke, I love that language, Fed boss Ben Bernanke, expressed concern that the U.S. gross domestic product could contract in the first 6 months of 2008. Bernanke is also expressing fear about a possible recession. What the hell does that mean, what I just read to you, Catherine?
It means he lives in a place where a lot of people are making money on government contracts, not a place like where I live. We've been in a recession for years, Dennis, down here. It means that he's trying to admit to an economic slowdown, but do it softly and gently. In fact, he's saying he expects growth to be back, within about 6 quarters. So,
but yesterday the stock market went up almost 400 points. Aren't things better?
Well, the stock market probably went up because the Fed is lending so much money to the investment banks who are manipulating the market.
I have to. I'm going to admit something on the air now, Catherine. My father was a consummate gambler. If it wasn't cards or dice, he was at the track. But you know what? When he lost, nobody gave him the money back.
Right.
How come these guys can gamble for billions and they get the money back?
Because they can.
Because they can.
Well, we have a central bank, which is the depository for the U.S. government, so it controls the government accounts, and it essentially can make the money and make the rules by which various financial institutions can multiply out and leverage the money. And as long as it can lend or print to its members and get away with it, it will.
Tell us about how Mr. Paulson plans to help us.
Well, Paulson's plan is fascinating because it really shows a direction of privatizing financial regulation under the control of essentially the large banks. Let me go back. The Federal Reserve System, which is our system of central banking in this country, the power in it is essentially 12 federal banks, one of which is in the Bay Area, the San Francisco Fed, and each federal bank is owned by its members. And you as a citizen, you and I as citizens, our listeners as citizens are not allowed to know who owns it in what percentages. We can just know that it's the member's bank. So we don't really know who owns it, but we know it's privately owned and controlled. Okay? And what Paulson is suggesting is at a federal level that significantly more control of regulation be moved out of agencies which are under the control of Congress and the president, so under the elected officials, and into the Fed, which is essentially owned and controlled by private parties, though it's a hybrid. So when you're privatizing regulation, then he's setting up, he divides his proposal into short-term, intermediate, long-term, and the short-term is really grossly oversimplified, Dennis, the stuff that the Fed and the Treasury have the power to do immediately. And then the intermediate is what will take budgetary or regulatory changes, and then the long-term requires big legal changes. But essentially, if you look at where he's going, what he's saying is we need to move the businesses which are under state regulation, which is the mortgage banking, insurance, and thrift charters and non-Fed banks, and move them up under the control of the federal government. But then as things come into the federal government, much more is going to be moved over to the Fed. And part of the Fed's powers, and it's really more of coming out of a closet, he takes something called the President's Working Group, which was a group originally formed in '88 and reconstituted with more powers in '98, and which is essentially a vehicle for managing the stock, bond, and commodities markets, really all financial markets. And we've been watching for literally a decade more and more dramatic intervention in the commodities and financial markets in a way that's breathtaking. I mean, the the Federal Reserve is really and the government is really intervening directly in the market, and that's why you see, suddenly the stock market flies up 400 points, gold drops down 100 points, and this is part of managing the currency, which right now, if you look at the key economic issue, we have a falling dollar and the currency is diminishing in value because the Fed is inflating so much.
Okay, a falling dollar, the currency diminishing in value. I mean, in real terms, what does that mean to us?
Here's what that means. According to the St. Louis Fed, one of the statistics they use to measure the money supply is called MZM, is growing in the last 4 weeks, grew at a rate on an annualized basis of 36.9%. What this means, if it were to continue without change, is our expenses would rise about 36% a year. So our food expenses, our our oil price at the pump, our day-to-day living expenses, once that flowed through the economy, would rise tremendously because the money supply is increasing so much. So think of it this way, grossly oversimplified. I'm the central bank. I print a whole lot of money. I use it to bail out Bear Stearns and Countrywide and all these different predatory lenders. And once I finish doing that, it means there's a whole bunch more money in circulation, and they're okay, but the rest of us have to fund it with, in essence, an inflation tax because there's just more paper money chasing the same amount of goods.
God, I'm thinking Countrywide. Now, I saw them advertising in USA Today, but I thought the FBI had about 16 indictments all over the country, and yet Bank of America is buying Countrywide, and now Countrywide's going to go help you prevent foreclosure?
The ad today on Yahoo Finance says right in the front page, Countrywide home loans. The Fed drops key interest rates again. Low rates on loans up to $729K in select areas. Act fast. Now, this is the true face of regulation because when a predatory lender goes bankrupt, what we do is we make sure that the Bank of America is there to support them, and the Fed drops interest rates so they can keep loaning more money at lower rates. I mean, it's funny, but it's not funny.
Wow. All right. We're speaking with Catherine Austin Fitts. This is Community Business. This is a weekly segment of Flashpoints on Pacifica Radio. Catherine Austin Fitts is a financial advisor. She is a former high-level official in economics, worked on Wall Street, knows a great deal about what's happening, and she is our sort of translator from Wall Street to Main Street. Okay, let's get to the positive side here, Catherine. I have promised that we will spend some time each week talking about what people can do. Now, I've already admitted that I'm in the process of taking my money out of Wells Fargo Bank. What would be wrong with keeping it in Wells Fargo? What am I doing wrong?
Well, in the last calculation I did, the banking system was basically lending a multiple of deposits of 164 times. So let's say what's your average balance over the last year?
I'm not telling you, but go on.
Well, let's just pretend it's $1,000.
Okay.
Okay. And so what that means is the bank you put that money in, and the banks that it sort of plays within the system can ultimately loan $164,000 because they have your account.
Really? Now, you mean I give $1,000, they get to give out $160,000?
$164,000 once it multiplies through the system. So let's just say that there's a big bank system and a little bank system, and if it multiplies and it keeps multiplying around the big banks, then ultimately the big banks can issue $164,000. But needless to say, it's amazing what Wells Fargo can do to